3, 2, 1.
Okay.
What's up, everybody?
It's the Ides of June.
Hope you can see us a little better. We got some new cameras.
The cameras there, fancy,
Hopefully
wireless.
it's a little clearer.
And I can tell where the camera's pointed now because there's little lights on there. And
yeah, man. It's
very
fancy. You guys can't see it. Maybe we'll take some pictures of it. I mean, it's nothing too crazy, but it's definitely better than our – I mean, so when we started this, it was during COVID. And really the first cameras we had were these little box things that were from Home Depot. Like all webcams were unbuyable, right?
During COVID.
Everything went to virtual, work from home, so you couldn't get anything. And then we went to camcorders, which is what a lot of podcasters use, but it had a lot of limitations, and particularly for this wide shot or whatever.
Right.
That's why you guys always saw it was a little dimmer, like for this shot. And then because people would always, they're like, why is it when it's just one of you guys, it's clear?
Right,
well, it's a different camera. Anyway,
no, these are good.
Nobody cares about all that crap, but at the end of the day, hopefully you guys throw in the comments section if you think it looks better, because help me feel better about all the crazy crap I did last week while Jerry was gallivanting around California.
Yeah.
All right,
it was gallivanting. It was a long, awesome week.
Yeah. What you got for us this week?
All right. So, TSP Weekly Podcast, 18 June 2023. So, I'm saying this is like my crystal ball. It's not really my crystal ball. It's kind of what the charts are indicating is what's going to happen in the future. But I want to go over, this is going to be some kind of non-TSP related things. But anybody that is looking to buy a house or sell a house, buy a car, sell a car, like credit cards, basically anything that you have to borrow money for, that you want to buy, interest rates is the only thing that matters. And so I got a chart of the 30-year fixed mortgage rate versus the 10-year yield. And you can see it's a pretty interesting chart. Then we'll kind of zoom in on the 10-year yield for a minute and then see how that, in terms of TSP, affects the F fund. And then seemingly out of left field, but this initial jobless claims, I have a chart of that over time versus the S&P 500, and you can really see when the initial jobless claims number starts moving higher, the market rolls over like clockwork. And it hasn't happened yet, which is odd, but we're going to take a look at that. And then Tesla is the bonus chart, and then weekly fund charts. All right. So before we get to all that, we got a really good question a couple weeks ago, and I promised I would do it on the show, but I was out of town last week, and I wanted to wait to get back and do it on the podcast. So I have a question that I've received several different answers to. When reallocating or adding to a position, say increasing C fund exposure from 50% to 70%, does the price you purchased at the 50% level get readjusted to the price you get at the 70% level? So if the C fund was at $4,200 when I purchased 50%, and it's $4,250 when I increased to 70%, does the entire C fund exposure get rebalanced to the $4,250 price at closing? I've been told it does. I've been told it doesn't. Can you clear it up? I don't know. Does it even matter? Yes, it's something that a lot of people have a really hard time getting their mind around. And so the interesting part of that question really is when I purchase the C fund. So you I don't even know how to explain this. When you add money every week, comes out of your paycheck, it goes into your TSP account. That's when you're buying quote unquote shares of the funds. Okay. Once you've done that, now the dollar value that you contributed goes into the big pot, right? So say you have $1 million in TSP. All you're doing is reallocating that dollar value between the funds. And when you do, you're going to get the increase or the decrease in the funds that you're allocated in. So if you buy shares in the C fund, if you reallocate into the C fund at $4,200, and the market goes up 1%, the value of your account, the amount that's in the C fund, goes up by 1%. You're not buying shares.
More shares, right? Like, so in the beginning there, like you said it, like the only time you're actually buying anything really is that new money that's coming in. So let's say that's just for sake of $250,
Yep.
right? Let's say it's $250 or $500, in your paycheck, and you're putting that in, and you're buying new something.
New shares of the C fund.
Do something,
Yeah.
right? After that point and given time, you're not really buying anything. All you're doing is moving your account balance to track with one of those fund performances.
Right.
You're not buying anything, right?
Right.
So just think, that's how I try to explain to people. There's buckets, right? You've got your bucket, and you decide where that money is going to be tracking that fund, because tracking it is a better term, because we're not buying anything in that fund. Really,
right.
you're not
You're not buying anything at all at the end of the day, ever.
We kind of say you're buying in with your new money. You're really not buying shares of anything.
Right. You're contributing more into the big pot is really all you're doing.
Yeah.
So like people, so if you were going to buy in a brokerage account, shares of the S&P 500, right? If I bought 10 shares, for $100 a piece, it would cost me $1,000, and each share is $100. So if the next week, if the price had moved up to $200 and I bought more shares of the S&P 500, then I would have the shares that I bought at $100 and the new shares that I bought at $200. But
and $1,000 would only buy you
half as many shares.
Right. But all those shares would now be worth whatever that new amount is, $200, because the 100 went up to 200, right? So they're worth 200.
Right.
So you made a profit on that, but it cost you more money to buy that's not what we're doing in the TSP.
No, not at all.
There's nothing. This is why I think it's probably one of the most important things for our followers, listeners, customers, the people that actually, it's the hardest thing to wrap your head around, because everybody talks about the stock market in terms of shares.
Right.
And when you're reallocating within the TSPs, all you're doing is saying, I want my pot of money to track the performance of that fund.
Right. That's right.
Right. And so if I want half my money to track the performance of the C fund, and half my money to track the performance of the S fund, that's how it's going to work out. So if that's 500,000 and 500,000, this 500,000 is going to track with the C fund, and this 500,000 is going to track with the S fund. And however that works out is, that's why we always say what you need to pay attention to is your account balance.
Right. That's right.
Not the number of shares you have, because you don't own any shares of anything. Right. Look at your account balance. Is it going up? Is it staying the same, or is it going down?
Right.
Our hope is that it's staying the same or going up.
Right.
That's and that's where people get lost, because they start to throw out, well, the C fund's doing this percent and you guys are doing this percent. Hey, man, you know what? Our account balance didn't go down.
Right.
That's what I'm looking at. If my account balance doesn't go down, I'm winning. If my account balance goes up, great. I'm happy for that. But what I really don't want it to do is to go down, whether I'm retired or not.
Right. Yeah, for sure.
Yeah, but this is probably one of the most important things. Two really important things if you follow our methodology. One is understanding this thing we're talking about, right? Reallocating money to track these funds versus you're not in a brokerage account, right? You're not. And so the other thing is this whole idea of a paper loss,
right?
All these things. Those are tax things. These are not things that happen in an IRA account, or you're not taking a paper loss. The loss happens when your account balance goes down.
Yeah, every day. If you look at it every day or every week, whatever. It's,
there's no such thing as a paper loss. Hold it. Don't sell it until the share is worth. You're talking about a totally different thing.
We're going to get a lot of pushback on this.
Yeah, we are.
That's fine.
But if you have another way to explain it, come on.
Yeah, put it in the comments. I mean, it gets complicated because, of course, the TSP tells you how many shares of which fund you own, and so they do themselves a disservice in the way they explain this thing.
Yeah, and the reason they do that is because they know that the average retail investor, us. Yeah. Only understands it from that perspective. If they tried to explain if they were just transparent and educational, right, which is what we're trying to be.
Yeah. It's not their job to teach you. It's just their job.
It's actually the opposite of their job to teach us.
Kind of.
If you really want to get into our opinion, they don't want us to be educated. They just want us to put their money in there and hope for the best. That's why they would love for us to put all of our money in the L fund,
and leave it.
Just make it. Because why? Because the administrative costs would be less for them, and yada yada yada. So, but that's not what you should do. What you should do is actively manage your TSP account and put your money in the funds that are either moving up or staying the same.
Right.
It really is that simple. You want to try not to be in the funds that are going down. Right. And this whole idea of buying cheap. Why would you buy a depreciating asset?
Yeah.
You're not buying anything.
Let's flip to that one because it's another big one.
Yeah.
When the market's going down, the value of your account is going down. And I kind of lost my train of thought from the you're not buying shares cheap. That's right. So you're only buying, quote unquote, buying when you're contributing new money into TSP. And so as the market goes down, every 2 weeks, whatever the price is on the day that the government contributes your amount into TSP, whatever the price is that day, that's the value of the shares that you're buying if you have your new money allocated to those funds. But say it's, like you said, $250 or $500 or whatever, you're getting into that fund at a lower price, let's say, if the market is down. But if the market came down that day, yes, you're buying cheap with your $250, but your core account came down by the same percent.
Mm-hmm.
So, I mean, if you have $1 million in TSP and the market's down 1% that day, you lost on paper $10,000. And you can say, yeah, but I got to buy in cheap. Yeah, with your $250 or $500 or whatever it is.
Yeah, you bought. But at the end of the day, your account balance went down. Particularly if maybe your money, your new money, and your current account aren't in the same fund.
Right.
Okay, I understand that. Great. But generally speaking, are you telling me wherever your money is at is not going down? Like, if you believe to be buying it with your new money, why wouldn't that money be in there?
Right.
So anyway, at the end of the day, hopefully we're not confusing you more than helping you. The real answer here is we're not talking about buying shares of stock.
Right.
We're just not. And once you can wrap your head around that and you say, okay, what I'm doing is putting my money in an allocation, a fund, and it's tracking the performance of that fund.
Yep.
Right. And that is the easiest way to think about it. And if you do that, then you think to yourself, okay, if the fund performance, C fund, S fund, whatever it is going up, then my account balance is going up.
Yep.
If it's going down, my account balance is going down. And that's why we use the tool of the G fund, right? Because we can go to the G fund, which generally it's not going to go down.
Yeah, no, it's not going to go down.
And so that is what we use as a safe haven to not lose account balance. Now, does that mean that we're not trying to beat the S&P 500? There's very few people out there that can. There's some, and you won't hear about them because they're extremely rich and they're not telling anybody how they're doing it. But if you even come close to it, you're out managing most people. And so the real key is not to focus on that. Focus on your account balance. Yep. If you go on our website and you check our performance, we're transparent with how our performance is. But one of the things we're pretty proud of is when you look at the chart of $100,000. If you had $100,000 in your account on X date, what would your account balance look like right now? And the most accurate one for us is probably the last year. And why do I say that? Well, because have we been doing this for 20 years? Jerry has, but not the way we do it now, which is a full-time job with lots more analytical tools, lots more information and data, and it's literally what we do for a living. That has pretty much been going on for about a year or so. Yeah. Everything before that, it was more like a part-time job, if you will, because we were like you guys, right? We were in the Gov, we were in the military. And so we made that transition and we were like, you know what? This is a valuable enough thing to do because nobody's given it to anyone, right? And so instead of us just going off in the corner and trying to, make money trading, this is a lot more, beneficial for people, but it's that's why the performance I think is fair to kind of grade us on over the last year. But we put up our 3-year and 5-year because
it is what it is.
It is what it is. Yeah. But the biggest takeaway here is start shifting that mentality from buying shares as like in a brokerage account.
Yep, Hopefully that answers the question.
Yeah.
Okay. All right. So like I said, it's not really my crystal ball, but I just want to kind of project some things out into the future. So the black line is the 30-year fixed mortgage rate in the U.S. Okay. The blue line is the 10-year yield, right? The yield on the 10-year bond. And so the first thing you can kind of see, so we're going back here to the early 70s, right? And here was the top in 1981. The difference between the black line and the blue line, okay, this is mortgage rates, this is 10-year yield. The delta in the middle is what your mortgage company makes on your loan. So the takeaway here is it pays to be a bank because you're making a pretty big commission consistently, which makes sense. I mean, they have to get paid, but that's the difference between the 10-year yield and the 30-year fixed mortgage interest rate. And so the rate up here, right, in the top in 1981, it was super expensive. It was 18, almost 20%, right, 18% to buy a 30-year fixed mortgage. And 10-year yield rate was really high. So over the last 40 years, rates have come down, right? Bottomed out in 2020 back here and had a big spike up since, right? So this in here, anybody that bought a house in here is locked in, if you got a 30-year fixed, is locked into a really super low rate, right? It was, under 3% was the mortgage rate there for, about 2 years probably. And then obviously it spiked up quite a bit and it's up now, got above 7% back here earlier this year. So what you want to look at is the Elliott wave count that we always talk about. So here was the bottom in rates, in mortgage rates, right? So we had a tick up for 1, 2, 3, 4, and rates should go higher. Okay, for a five wave. So rates go higher for a little while longer. Then you get a correction, A, B, C. This correction is probably going to be pretty significant, right? It won't come down below this low, but say it gets back to 4%. That's your last best time to buy something because this is going to be a 1, 2, 3, 4, 5, right? So what I'm saying is we had a 40-year decline in rates. We hit a bottom, and we're looking for an increase in rates over time. That's the crystal ball. Whether or not it happens, I don't know. I mean, can rates just kind of do like this? Sure. But the Fed is going to continue to raise rates. In the short term, rates are going higher. We have a recession. They break something in the stock market, rates will come down. And when they tick back up, right there is your last best time to buy things that you want to buy on credit. All right, I'm going to kind of talk about that a lot more in the newsletter, but it's one of the most important things you can watch right now is interest rates. And if you zoom in, this is kind of a zoom in of what I meant. This is the 10-year yield. We hit a low back there in 2020. You get 1, 2, 3, 4, and we're looking for another leg up in rates. And so how does that affect us in TSP? Rates go inverse to price. So the F fund is not the same as a 10-year yield, but it tracks, all the sort of the long end of the bond curve kind of track the similar, right? So the 2-year yield doesn't really look like this, but the 10-year, 30-year, anything that's kind of on the long end looks like this. So if yield goes up, price is going down. So here's the F fund. We had a top in price because we had a low in yield, right? We had the low in yield here. We had a top in price here. And you do the same count. So on yield, you have a 1, 2, 3, 4, and we want one more leg higher in yield. In price, you got 1, 2, 3, 4, and you get one more leg down in price, right? So rates are the most important thing to watch right now. Okay. So the other one I wanted to do is initial jobless claims. So the black number, the black line is initial jobless claims, and the orange is the S&P 500, right? So when the market's going up, people are employed, right? So you don't have a bunch of people going to the state unemployment office and making new claims because everybody's got a job. Once people start getting unemployed, the market goes down. Okay. When people start, getting rehired and all that, the market's going up. We hit that bottom in 2001, double bottom 2001 into 2003 actually, and then everybody got rehired. Employment, initial claims goes down. 2008, we started this uptick in jobless claims, and then it really took off when we had that big collapse in 2008, right? When Bear Stearns and all the rest of them collapsed. And so then we hit the bottom. Of course, jobless claims go down, market goes up. Okay, you get the idea. Huge spike, obviously, in claims from COVID, right? But we had already put in a higher low even before we had this big spike up. There were a lot of indications that something was going to happen in 2019. I mean, COVID was obviously an outlier, but we were probably going to have a recession anyway. But then COVID happened and kind of the whole thing went sideways. But the interesting thing here is it's very consistent. When initial claims are going down, the market's doing well, and it makes sense. When initial claims are going up, the market's not doing well, right? The strange thing is right here. The market's been going up since this October bottom. And so is initial jobless claims, right? You don't see that anywhere else on the chart. For a pretty long time, close to a year at this point, the market's going higher and initial jobless claims are going higher. Okay? Something is out of whack. This is fundamental. When people start getting out of work, they're not buying stuff, and the market needs to reflect that, and it doesn't right now. So either the market keeps going higher and people start getting employed and this number starts coming down, or the market catches up, initial jobless claims keep going, and the market rolls over. So it's going to be really interesting to see, but that's another really good chart to watch is initial jobless claims versus the S&P 500. Okay. Bonus chart is Tesla. Hopefully, it's funny because Jim Cramer, he had Tesla. It was like a week ago, maybe 2 weeks ago. He was like, buy Tesla. And a lot of people are on the buy Tesla train. And it's pretty obvious if you look at a chart why you'd be on the buy Tesla train. So I totally agree, but it's just odd that usually if you go opposite to what Cramer says to do, you do better than going with what he does say to do. But if we look at a chart of Tesla, the Elliott wave pattern is like so crystal clear. So I'm going to look at this in two ways. So the first one is actual price. Okay, so Tesla split a bunch of times, and which is why down here, it looks like it's what is this, $20 a share? But it split a bunch of times, which is why it's only why it looks like it was $20 a share back here in 2019, which it wasn't. But price goes up 1, 2, 3, 4, 5, right? And then it rolls over 1, 2, 3. Okay, so that's how the Elliott wave pattern works. 1, 2, 3, 4, 5. In an impulse move up, and then ABC correction, which corrected this whole move up, and then this whole thing will be a 1, 2, and then we'll get 3, 4, 5. Okay, in the long run. And so you might look at it and go, well, you want to see form and proportion in the chart. And so you look at it and go, okay, this is a big run up. I get that. This is a little correction right here. Then you have this big run up and this really big correction. So how does the 2 and the 4, like this doesn't look like it should be relative to this, right? So if you go to a logarithmic chart, so this is the percent value of the gains and losses, right? So on a percentage basis, this 1, 2 now is much more significant than this 4 is, right? Because on a percentage basis, you actually made a whole lot more than it looks like on a nominal basis over here. Does that make sense? Okay. So it's good to look both at the nominal, just the numbers, but also the logarithmic, and the more price moves, the more important it is to look at it on a log scale. So we had a 1, 2, 3, ABC for 4, 5, blow off top at a 5, and that's going to be a 1. And you got what looked like ABC, right? This could have been the 2, and then we kept going. But that's not what happened. It became a more complex correction. So you got ABC for 1. Let's call it that. ABC for 1, 2, 3, which this would be the A, this would be the B, and this would be the C. Right? So now going forward, so this is why Tesla's kind of a no-brainer at this point, because we just had this big correction, the 2 wave, and now we're in a 1, ABC for 2, 3, 4, 5. Like virtually guaranteed Tesla goes higher. And I just jinxed everybody that owns Tesla. But this week right here was kind of a no-brainer.
It's hard for me to see because it's a little smaller. Where did fear kick in and everybody got out?
Yeah, well,
that was down there, right?
Yeah, those 2 weeks were rough. But until you put in a bottom here, you don't know, because could it have rolled over and kept going? It's possible. But if you did the projection, I didn't do it. Let's see.
Because you don't really have some trend lines on there to help it be a little bit more visible. But
yeah.
if you did, you could definitely see that a little better. If you throw in some trend lines, you could see when it got out of the channel and when it went back in, and that's something that is for me is very helpful as a beginning kind of trader trying to do this technical analysis. I love my moving averages and I love my channels because that gets my brain, because you see the channels already, right? Because you do this all the time, and so you don't need the channels, and you're more trying to see the wave. Right. Whereas those of us that are not as up to speed on the Elliott wave count, I'm more interested in seeing the moving average and the channel lines, and that's enough for me to go, oh, the trend has changed. Like it's obvious now. To predict a little better, you're going to have to use something like Elliott wave, right? Because that's going to give you a little bit more probability of what's coming, and then when you match all those up together, right? Cross the moving average or left a channel, resistance, whichever version of that you like, because they're all generally kind of the same thing. You're using these lines to give you something visual to kind of work with. And so that works better for me. And then, of course, if you throw on the Elliott wave, it helps you see, oh, okay, this is probably what's going to happen. It's not for sure, right?
Yeah, no, the way it helps me the most, honestly, is this is a long-term weekly chart, right? So if you do the Elliott wave counts, are we on the chart? Okay, so say you're in, this channel, and you're doing the Elliott wave count, and you see we started, at a low down here. We got a 1, 2, 3, a really nice ABC 4. So you're in a 5 wave in this channel, and then you got to blow off top, like that. That's a great time to get out, because you should be anticipating. You don't know how long the 5 is going to go, but once it does start to correct, and maybe, it comes down, it maintained that line, and so maybe you don't get out until it breaks the line.
That's where I would see it, right? Yeah. So as a simple version of that, that's where I would see it, right? If you took all the Elliott wave count out of it, to me, that's where I would get out, just because, oh no, it broke the trend, I'm getting out, right? And again, remember, everyone, that we are talking about, this is not in our TSP, right? So we can get in and we can get out. We can get in and we can get out. So when you're doing this in your brokerage account or IRA, those gloves are off. We don't have the 2 moves a month, right? Because sometimes that gets lost. And like, well, why don't we do this in the TSP? Because we only got 2 moves a month,
Right.
and we got to have it in by noon.
Right.
None of those rules exist when you get over here to the IRA. So if you're in your IRA account in Fidelity or whatever, what Jerry and I just showed you with any particular, this is just a one particular company. You do this with any index, ETF, sector,
anything.
whatever.
Yep. And we do it with TSP. It's just that we have to, once you figure out that you're at a place that you want to make a reallocation, then you got to look at where am I in terms of 2 moves a month.
Right.
I mean, honestly, that gets more tricky than.
You start with a sell signal, right? So you start with a sell signal or a buy signal, and then you have to say, okay, but where am I at? Have I already made a move?
Right.
Do I have 2 moves left? Do I have 1 move left? Do I have 0 moves left?
Right.
Is my only move to get out into the G fund? Because you can always do that. That is the safety net that is good, that you can always get out. But where are you in that? Right. So start with, here's what I should do, and now can I do it?
Right. Yeah. It's complicated to get, not really good at, but there's definitely more than just seeing that, I need to buy or I need to sell.
Mm-hmm.
Okay. So that's Tesla. The last thing I want to say about that. So if you're, if you did the count, right, 1, 2, 3, 4, 5, and it starts to churn, you should be much more concerned after a 5-wave count that it's going to go lower than you would be like back here, right, or this, because once you see a 4-wave, the 5 is coming. So you bought it here. You rode that 5-wave up, and any of these little movements down here, you're not too worried about because you got the 5-wave is in place. But once you get into this part of the correction, you had a pretty good uptick right here, but it's suspect. And the same kinds of ideas apply to TSP. So fund charts, I'm going to come back to the dollar. So this is the weekly chart of the C fund, right? So each tick is a week, 20-week moving average line, relative strength, and MACD. So we hit a low in October, right? 2022. We came up for 1, A, B, C for 2, and it looks like now we're in the middle of a 3, right? So given there's all kinds of macroeconomic things going on in the world and impending recession and all this other stuff, but this is a very clear 1, ABC for 2, and we keep going for 3. So it looks to me like the market wants to go higher. And so having said that, any kind of pullback that we have, as long as it stays generally within this channel, any little pullback here isn't a concern that the market's going to crash because it's not consistent with the chart. It could. It just means that I would tend to give it a little bit of leeway, especially here because this week, it's a ridiculous up week that we kind of, if you've been following the show, we talked about once we get above that August high, a ton of money pours into the market, and we definitely saw that this week. So I'm not saying, if you're not already in the stock funds, you should jump in there. But what I'm saying is you should have gotten back in. If you were following along, we kind of got back in, 50% here and 100% back in here somewhere, because the chart's calling for it. It pains me to do it because the macroeconomic conditions are ridiculous. Like there's no reason why the market should be going higher, but I don't care that there's every reason that it should be going lower. It's going higher, so I want to be in it. Okay, let me flip back to the dollar real quick. So this is a weekly chart of the dollar, and it affects the I fund really more than the stock funds. But in general, when we have weakness in the dollar, stocks go up. So here was 2022. The dollar was already starting to move higher, but then really starts moving higher through 2022, and this was the bear market, right, for stocks. The dollar tops out in October 2022 and starts rolling over, right? And that was the bottom in stocks. When the dollar gets weak, stocks go up. So as we're looking at this chart, we had a big down week for the dollar, and if the dollar takes out this low, and keeps moving down, stocks keep moving up, and especially the I fund. So the dollar at this point is a really important one to watch, because if it does get support here and turns back up the other way, the market's going to crash. It's the way it works. Okay, so the dollar is a really good one to watch. So C fund we did. S fund looks super strong. I mean, we're going to get some resistance up here at 1840-ish, because we're going to hit, basically this two levels of 2 times it came up and hit that level and couldn't get above it. But we have higher lows all the way along. And RSI is clearly breaking out to the upside and has a lot more room to go before it gets overbought. And MACD is cross positive. So S fund looks really good. I fund, like I said, huge down week for the dollar, huge up week for the I fund. Definitely hit support there at its 20-week moving average line, bounced off it to the upside. I fund never got below 50 RSI on weekly, and it's turned back up this week. And MACD is starting to turn back up the other way. It was negative a little bit, but not a whole lot. So like we said last week, the I fund is looking pretty strong. So the stock funds look great. F fund, we kind of already looked at it, but this was the first low for wave 3. A, B, C, maybe. I don't know, this 4 wave is getting a little bit long, but we pretty clearly have this frowny face, as J.C. Peretz would say, and we're coming up and hitting resistance there at that 20-week moving average line. It really looks like the next wave down is kind of imminent on the F fund, which means interest rates are going higher. It all relates together. So that is all I got. A little bit of a disjointed show, but a lot of good stuff in there, I think.
I'm about to turn my microphone on. That's so you guys don't get to hear me drinking water. Jerry's a lot more quieter than I am when he drinks water. No, I don't think it was disjointed at all. I think it was great. There's a lot of good pieces in there, and so hopefully you guys got some good information out of it. Again, we do this every week. The last piece of this where we talk about the TSP fund charts, I challenge you to find anywhere that anyone does that. We can't find it if they do, and so it gives you lots of information on how you can manage your account. If you want to get more information on how to do that, you can join our site, and what you get there is we dig a lot deeper. Jerry puts out a whole newsletter that's written and a video, so he kind of walks you through it. If you're like me and you're kind of reading challenged sometimes, I like to hear Jerry explain it to me. And but yeah, that's what they get every Sunday night before the week starts. So you can draw your lines in the sand, make your plan, do all of that. It's very useful. If you guys have any questions or comments, please put them in the comment section wherever you find this video. If you can't find a comment section, just shoot us an email at support@growmytsp.com, and the support crew will make its way to us. Hope you guys have a great week. It's a short week, should be, if you're federal holiday on
Monday.
Monday. Other than that, you guys stay safe, and we will see you soon.
Next week.